Welcome to the weekly update, where I'll go over the action in the market for the week of March 11th through the 15th, and then we'll see how things look for the week of March 18th through the 22nd. We had another slight down week for the S&P 500. The market is kind of figuring out, does it want to pull back? Do we need some kind of a correction? We've been going up pretty solid, really since last October. We got off to a rough start in early 2024, but since that time, the market's just been marching higher. It was throwing a couple of curveballs this past week. We had CPI and PPI that both came in stronger than expected. That's causing the market to rethink the scenario concerning inflation and interest rates, and it's making things a little more confusing for right now. When we look at our weekly charts, we're mainly positive. We're starting to show some weakness on the daily charts. So we'll just keep an eye on that. I analyze that every day, and then we'll just see if that bleeds over into the weekly charts. So before I get going, please view the daily videos for daily commentary and analysis. What I'm trying to do in this video is I'm dropping out the daily information that I've been covering. I know that might be difficult for some of you because the daily videos are usually about 30 minutes long, and I'm trying to not make the weekly video so long. And plus, I'm duplicating a lot of the analysis that I give here. So just to try to make this video a little bit shorter, I'm not going to go over the daily charts that I usually have been going over as well. Let me know if that's really messing you up. If you watch just the weekly videos and you liked the daily charts that I included, let me know. I'll see what kind of feedback I get and then kind of adapt based on what works best for you. Making this a little bit shorter also kind of makes it work a little better for me. Also, probably in about June or so, I'm looking at possibly at that time launching the program that I have. And I'm going to go ahead and prepare a video. I announced it in the daily video for Monday. I talked about some ideas. I'm going to get a lot of questions about that as the channel has been growing. So what I'm going to do is very soon, over the next day or two, I'm going to prepare what I have in mind for the video as far as what the program will entail and the benefits that I feel that you'll get out of that, the cost and so forth. And I'm building all of this myself. I'm literally years behind where I wanted to be with this by now, but it's just the way things go. So be looking for that. If you're interested in taking what I do and my analysis to the next level, I'll be putting out some information. Now, it's going to be kind of the same for those of you that have been watching the video for a while, and I've made videos like this before. Not a lot of difference, but this will just be more updated with some new ideas. I do have a PDF that's available in the description below every video that I post. Some folks find that useful to download. I also have started a new video. So far, it's just been a weekly video. I say it's on an as-needed basis, but then I usually prepare this as the very last video each week. And we really haven't seen any massive changes for me to do any updated versions of that video. So it'll at least be posted once a week and then on an as-needed basis within the week. I do post the pivot points each day on the community tab in the YouTube channel. Some folks find that helpful. I can't do that on Rumble. I can only do it over on YouTube. And there's intraday pivot points, which are really very significant. And then there are pivot points that last for the whole month. And that's updated with each bar or candle for each particular day. I do have a private Facebook group that you're welcome to join. It's not really active. I kind of had this idea of putting this group together so we could have some back and forth. I could share some information, but that just doesn't seem to be all that popular. I will be posting a new poll. I haven't actually posted it yet, and I'll be going over the results of the latest poll. And then I really watched the YouTube and Rumble comments. I'm still playing whack-a-mole with, especially on Rumble. I get these comments talking about how great and wonderful the videos are. Here's my WhatsApp. Here, I'm a YouTube expert. My goodness, I didn't know there were so many YouTube experts out there. They attended some kind of webinar or something, and someone told them this is a way to try to bring up some business. I delete those. because I don't take those serious. Now, if you want to post something in the comments, you agree, disagree, you like, you don't like, I'm fine with that. We can have a back and forth. If you want to keep it more private, I have my email address at the end of each video that I post, so you can contact me that way in a more private manner. I also post on Rumble. I've kind of been talking about that as well. I post on YouTube and on Rumble. Sometimes I have some uploading problems. It's been okay the last week or so, but sometimes I have trouble on Rumble, then I have trouble on YouTube. If you can't find the video in one place, look for it in the other place, and maybe it's just because I can't seem to get it uploaded. Here is the link for the Rumble channel. Let's go back and talk about this past week. For the week, we were down 0.13%. So it wasn't a real downer. It was a negative week, but we didn't see a huge percentage gain by the time we finished. Volume was above average, and there should be another little mark here. We were above average because it was quadruple witching. There's every quarter, there's a bunch of different options that all expire at the same time. Some people call it triple witching. Now, with some other instruments that are out there, they call it quadruple witching, and that can produce a pretty wild day for Friday, but it can also really bump up the volume. And what we've been seeing lately is on down days, we're seeing a pickup in volume. At least we saw that on Thursday. We saw it on Friday, but again, since it was options expiration, that kind of comes in above average with volume anyway. We are still positive when we look at our weekly charts. It's about inflation and interest rates, and that's the scenario that's kind of being challenged right now. The market thought, okay, the Fed's done raising rates. They're probably going to lower rates at some point in 2024. Inflation is coming down. Well, then we had CPI and PPI come out this past week that were actually up, and the market could have tanked. The idea that it's hung in there for right now just shows how positive we are at this time. But at some point, things could start coming into the market that could really produce some fear and lead to more selling than buying. We want to keep an eye on the geopolitical concerns. Of course, the market's not really paying attention to those. We're kind of getting near the end now of earnings season. We're kind of in between with that. And then we're going to have the FOMC coming out on Wednesday and making an announcement. They're probably not going to change rates. It's what they say in their statement, and then it's what is Chairman Powell going to say in his press conference after the meeting. The market is really hanging on that right now. We are still in a strengthening trend when we look at the weekly chart. The ADX is going up. We're above the moving average. We're actually declining. We've been on top of the moving average on the daily charts, and now we're starting to decline. We're still positive on the daily charts, but we're seeing a weakening trend where it's more of a strengthening trend that we're still seeing on the weekly chart. So looking at the week, the Dow was pretty much unchanged. It didn't really see all that much action by the time we got done. The NASDAQ was down 0.7%. The S&P was down 0.1%, and small caps, as represented by the Russell, they were down 2.1%. And there are some logical reasons for that. If interest rates are starting to go back up, these are small companies. They have to borrow a lot to try to grow. And if they're borrowing money at higher interest rates, that's going to feed into their earnings ultimately. And they may have debt that they have to refinance. And if they're at a lower interest rate, what they have right now, and then they have to refinance that into a higher interest rate, that could also have an impact. And plus, you just don't have the quality of companies in the small caps that you have in the large caps. Even the large caps, most of them started as small caps, and as they became stronger companies, then the number of shares and the size of the company ended up growing as well. Okay, so for the week, the major indices or indexes, depending on whether you're from the UK or the US, we had modest declines while the small caps underperformed. CPI and PPI came in hot, but the market didn't really negatively react to that. In fact, on Tuesday, after the hot CPI number came out, the S&P ended up closing at a new all-time high. In fact, I mentioned that here in the next point. So they're like, okay, this is when you know the market is getting a little ahead of itself, possibly. It could have tanked on this news. But when they say, well, yeah, that report was kind of bad, but if we look deeper inside the report, the shelter index, well, that looks like it's coming down. So we think CPI is going to be lower looking forward. The market doesn't usually do things like that, rationalize things away. So, but at least on Tuesday anyway, we did set another new all-time high. Interest rates were up, and this is starting to put pressure on stocks. We are at 4.31%. Some have it at 4.30%. I rounded it up where other folks are rounding it down. Retail sales were weaker than expected. So we're seeing inflation coming in hotter at the consumer and producer levels. And then even though we saw a bounce in retail sales, they were weaker than expected because we saw a real decline in the prior month. The markets, and this is kind of the consensus that's going around, they're due for a pullback. Of course, when you have everybody thinking the same way, usually the opposite happens. So just because everyone thinks we should have a pullback doesn't necessarily mean we're going to have one. And yeah, we've had a couple of down days now, but it hasn't been anything really that significant, at least to this point. Here's a look at the inflation chart that I've been showing for almost a year now, where we're watching this blue line. This is 1966 to 1982 and what inflation was doing. Okay. It was doing during that time where we do see a decline. Now, even when we're declining here, back as we were in 1976, good old bicentennial year, we did see some periods where this ticked up a little bit, but then it did resume going down. Now, at some point, we're going to bottom with inflation. And then if something happens like what happened in the mid to late 70s into the 80s, this could see a real takeoff in inflation. We don't know if it's going to play out that way. Of course, you can watch 10 different YouTube videos and half will say inflation's under control. The other half they'll say that the market's getting ready to fall apart. So, okay, we closed at 4.31% for the 10-year yield. That's above the 4.02%, according to Renmac. That's where it starts doing some damage to corporate profits when even the bigger companies have to borrow at those rates. Here are the poll results, and this is back for a week ago. And the one question I ask is, there are suggestions that the stock market is in a bubble, and I addressed that pretty much a week ago. Others say that stocks are not in a bubble. Do you feel that we're in a bubble or not in a bubble? 27% said that we are in a bubble. 73% said we're not in a bubble. And then interest rates are falling, but still above 4%. Now, they rose this week, but they were coming down a week ago with the 10-year yield. Do you feel that the yield will fall below 4% over the next few weeks? 25% said yes, 75% said no. So far, the no's have it. And then Friday, a week ago, started off positive, then led to a decline. Do you feel that this is a normal pullback, or will this lead to a more substantial decline? 64% right now think that it's just a normal pullback, where 36% think it'll be a more substantial decline. And we're still out, the jury's out on that one right now. Yeah, we've pulled back a little bit, and we started this a week ago, but we're not seeing anything that crazy, at least yet. All indexes except for the small caps have achieved recent all-time highs. Do you feel that the small caps will set new all-time highs? And I just said, okay, in 2024, at some point, 60% said yes, 40% said no. All right, here's some Isabel Net blog charts. I go through this every week. These are earnings projections going out into the future, and they still continue to rise, whether it's Morgan Stanley or a consensus. The takeaway from this one is at the top. A good first 50 days, which is what we've had, could mean a great rest of the year. And they look at all these different times. We come up with the average median, or the average here, 12.6%, 12.1%. We're higher 24 times out of 25 times for 96%. And then you have the averages down here at the bottom. So it just tends to look better going forward according to these statistics. And then we are still looking rather extreme, even though on the charts that we follow, we're starting to come down. This is showing that sentiment, it hasn't been this high in a long time here. Folks are getting a little too exuberant about things. And then this is looking at CPI, and based on what the next reading is, whether it comes in up 0.1, 0.2, 3, or 4, and then projecting that out of what that will be on an annual basis, the Fed is still trying to get back down to its 2% target rate. And then we're seeing all the craziness going on now with Bitcoin and the cryptocurrencies. and gold is doing quite well right now. And this is all the money that's just flying into that. Now, some of this has to do with the new ETFs, the crypto ETFs that you can get into. And so you've got a lot of big money that's having to buy those ETFs and buy into it. And that could be giving some real support to crypto. And even though gold has been going up, we're actually going down as far as money that's flowing in to buy gold. And then looking at, these are financial advisors. Do they expect the bull market to continue beyond 2024? 77%. These are the professionals, and these are the folks that have licenses to give other people advice about their investments, something which I don't have and I never want to have. I'm an educator, but they're looking pretty optimistic that we're going to continue going up beyond 2024. Then looking at small caps, and these are really under a lot of pressure now. When you look at them on a valuation basis, you compare the forward PE the PE ratio with the Russell 2000 and the Russell 1000. Those are the large caps. This is just showing that small caps are they're historically cheap. Just because something is cheap does not necessarily mean it's a good buy. So that's why we're just not seeing an awful lot of strength right now. Typically, what will happen when the economy is doing better and the stock market's doing well, when the small caps kick into gear, that's when folks are okay with their more, I guess, conservative investments or investments that have stood more the test of time. And now they're willing to jump into the small caps and maybe take a little risk there. We're just not seeing that. We saw it back in December. It was looking a little bit better a week ago. And even in Friday's session, the mid caps and the small caps were up when the larger indexes were down. But you look at this on a valuation basis, and they're still considered to be inexpensive. And then this is a chart that I've been showing for a while. If the Fed at some point is able to even cut rates, if they can do it in a slow manner and react to what's happening in the economy, whether we're seeing employment starting to fall off or maybe inflation is getting pretty low, then that tends to be more positive for the market. If we have some kind of big event that's really negative, like a 9/11, a great financial crisis, the COVID lockdowns, which of course could happen at any time, and then if the Fed has to come in and cut rates just because the economy may start falling apart, that tends to be more negative for stocks. And that's pretty much what this chart is showing. We did have a couple of posts from FactSet. It says it's the lowest number of S&P 500 companies that are citing ESG. Now, ESG is a bit controversial, and there's been a real push for it on one side and a real resistance to it on another side. At some point, I'm going to break this down and do a special video on this. And it's starting to kind of go away, but be aware, it's not really going away. What typically happens when, especially with the government, when something fails that they want to have go through, they just repackage it, give it a different name, and push it through, just having it look a little bit different and bury it a little bit deeper. But ESG in and of itself, it was a buzzword here for a while back in 2021 and into 2022. A lot of folks were coming out saying, no. This basically looks at, you're not a shareholder anymore. That means you're an owner of the company. They call you a stakeholder, and there's more equity, and there's all these green things that you have to live up to, and all this diversity. And people are like, wait a minute, I want to invest in companies that are good quality. I don't really care about all that other stuff. Where other people say, yeah, that other stuff is important, and we're going to start rating companies based on those things. And that's kind of the back and forth that is going on here. They're talking about ESG in and of itself less. That doesn't mean it's necessarily gone away. And I try to keep on top of this. So if it looks like a pig and they're putting lipstick on it and they're trying to make it actually be, they might look a little different, but it might end up still being the same thing. All right, then it's the second highest number of S&P 500 companies citing AI. Can't even say that, AI on earnings calls over the past 10 years. We're seeing it really going up. This is all the rage right now. And over here, you can also see how this is making a change on things, especially when it comes into their earnings. Then looking at our charts, here's going back to Monday, where we did gap lower in Monday's session, but then we were able to work our way higher. Tuesday, this is when CPI came out, and we really shot up. we came back down, and this is when we set a new all-time high for the S&P 500. We were pretty much flat in Wednesday's session. That was a real yawner. We saw a little bit of a sell program and then come right back up. And then here we had PPI, which came in stronger than expected. That put some pressure on a very choppy session. Then in Friday's session, we ended up gapping lower, and it was, again, another really choppy day as we were dealing with options expiration. Man, this is just the 5 trading days of the week. All of the indexes were down. The S&P was down the least. The small caps were down the most. Going back to the beginning of the year, we have the NASDAQ, S&P, and NASDAQ 100. They're doing the best. All of the other indexes are up, except the small caps are negative going back to the beginning of 2024. Looking at our sectors, I sort this according to what changed. And since we had a down week, I sort it by what was down the most. We had real estate, discretionary. That's been a real disappointing area. And tech ended up being down. Other areas that were up the most, we had materials, and energy has been seeing a bounce. As things are kind of shifting around, folks are getting out of tech and jumping back into energy a little bit. And then this is another chart where I rate it on its scooter score. The higher the score, the better looking that sector. Right now, we have the financial sector looking the best, followed by technology, industrial, materials, and communication. Tech and communication, those have been the 2 big, strong areas. And unfortunately, we have discretionary that's near the bottom. This would be another area that was doing better a while back in early 2023, but and it's mainly Tesla that's really dragging that down. And this has been an area that's been really underperforming. Then we look at an RRG graph here, which is a relative rotation graph. Just to kind of remind you, this is going back to your geometry class, where you have an x-axis, which is the flat line. We have a y-axis, which is the up and down line. When we're in the right-hand corner, that's a plus plus. And we're seeing here where communication has been one of the stronger areas. Now, this goes back over the last year. And then we're seeing the financials pulling back a little bit, as well as tech pulling back. And we have energy, it's got a really long tail. It's been the weaker area, but it's kind of coming to life right now and could be showing some signs of improvement. And then this is looking at the other indexes, and I'm comparing this to a new version of the Wilshire 5000. And this also goes back over the last year, where we have the S&P 100 and the S&P itself doing the best. We're seeing a bit of weakness here in the NASDAQ 100. And again, this goes back over a year. And then we have way over here, the utilities. They've been just under a lot of pressure. Oh, and small caps are also, they were looking better, but now start to be doing a little bit worse. Then looking at the sectors just for the 5 trading days, where we had energy, and that did the best. There were some other areas that hung in there, but we had a lot of sectors that ended up being down with real estate. And with interest rates going back up, that's pressuring real estate. Going back to the beginning of the year, we have communication and tech. Discretionary used to be in here too, but now it's way down here and is down going back to the beginning of the year. Looking at sentiment, we did get an extreme reading earlier on, and now we're starting to come down from that. We ended up closing at 70 on Friday. This is where we were above that 75 level, and now we're starting to come down. We've been up here for quite a while. Now, we can stay up here, and in a positive environment, we will. And we can even go back up and be higher than that. But this is probably going to come down if we continue to see more weakness in the market. Here's the active asset managers, where they're really extreme. And when they get above this red line, that's when we start to use this, and they're above 100 too. We use this as a contrarian indicator. Even though these are professional managers, they're human. They get caught up with FOMO, the fear of being left behind. They have quarterly reports that they have to prepare. They have peers that they have to brag to. And so a lot of them start getting positive at about the same time, and now they're getting really extreme positive. Now, this is about a week old now. And then here's another look at that same chart. We're up at 104.75. That's the highest reading that we see on this chart. Looking at the VIX, we are seeing it going up. And on the daily chart, we're seeing a series of higher lows here. Even since going back to the beginning of December, we are seeing the VIX starting to creep up here. We're not seeing it as pronounced here on the bar chart because there's a little bit more noise on that chart. The Ulster index is not really moving. I've dropped it out of the daily video because it's just camped down here at the bottom. it really won't kick into gear unless we really start to fall. And the RIDEX bear bull ratio, this is as of Thursday's close. You still have folks that are getting pretty optimistic here. And when we get to pretty high readings, that means they're bullish on the market. That's when we start to think of using this as a contrarian indicator. This is another one, the Investors Intelligence. This came out on March 12th. We were above 3. Now we've shot up to above 4. These are folks that recommend stocks and make suggestions. And a lot of them are getting bullish right now at the same time. When they're all saying the same thing at the same time, that's when we start to use this as a contrarian indicator. The latest reading from the American Association of Individual Investors, this was actually surprising. We were getting up to this pink line and we actually dropped down in the latest reading. We're still going up, but with the solid up week a week ago, even though with Friday being down, you might have thought, at least I would have thought, that this would have continued to go up. It actually fell back just a little bit. So this is not extreme right now. This is still looking okay. When we see this black line going down, that means that the tech sector is outperforming cash. And that's what we're continuing to do. We're not really seeing much of a bump here at all. Looking at the economy, this is GDP, where the Atlanta Fed GDP now estimate is right at about maybe 2.25%. When you look at different economists, they're at about 2.5% to the upside, and they're a little bit below 1% to the downside. This is looking at GDP now based on bars. The takeaway from this is all of these are positive, because one of the parts of a definition of a recession is that we have negative GDP for 2 quarters, and it's still looking good for GDP right now. We are continuing to decline when we look at the spread between risky and not as risky bonds. If this was really starting to shoot up, that would cause us a lot of concern. The latest readings from the Chicago Fed National Financial Conditions Index still has us, we're flattening out here, but we're still well below this black line. We get concerned when we go above the black line. And this is getting a little old now. It was updated on February 5th. This just shows that the tightening standards are coming down a bit with folks or banks that are loaning money to folks. We got a new reading here recently with the real-time SOM recession. I can never say that. Real-time SOM rural recession indicator. You'd think they'd come up with these nice little, please, short names that are easy to remember, but no, we're still below this red line. We get concerned if we go above the red line, and we're not there yet. This is also just barely above the black line. We're concerned if we get above the red line. And then looking at the Brave Butters, this was updated on the 4th. It is coming down a little bit. So we're not seeing any real warning signs here. The problem with these charts put out by the Fed, and you go to Fred, which is the website where I get these charts, they're great at telling you exactly what you should have done 3 months after it happened. And so that's one frustrating thing here is that the charts are good, but they're so late with how they report. Inflation now, this is just the adjustments. We've been seeing a little bit of a tick up when we're looking at inflation. Now, eventually, when we get to the end of March, this whole line here is going to go away because we're going to start a new quarter. Then here's where we are. The Fed's going to meet this week. There is a 98% chance that they're going to leave rates currently where they're at. That's at 5.25 to 5.5. You still have 2% of folks over here thinking, no, they're going to cut rates 0.25%. And this is how it's changed. And we've just seen this going up from where it is now, a day ago, a week ago, a month ago. They're getting more convinced that they're not going to change rates at the upcoming meeting. The next meeting after that is going to be May 1st. And now we're seeing a change here. There's a 93.6% chance that they'll also not change rates at this point. And you can see how this has really become more convicting just over the latest reading a day ago and a week ago. These two numbers, this is in reaction to CPI. And so we're seeing, well, maybe they're not going to raise rates, but with those strong economic reports that came out, it looks like they may not even raise rates or lower rates in May as well. And this should have been as of March 15th. Sorry. And we're looking at the balance sheet. There may be some talk about quantitative tapering that's coming along. We'll see if Jerome Powell's going to talk about that. But for right now, we're seeing the balance sheet continue to decline. The year over year is also showing a decline. Looking at breadth, we're still looking good here, and we're still looking okay on the daily charts. We turned down a little bit on Thursday and Friday, but it's been hanging in there. Some of the internals that we're seeing are holding together for right now on the daily charts, and we're still looking positive here on the weekly charts, both based on price and volume. And when we look at the new highs versus new lows, it's coming down, but it's still hanging in there for right now. We're pretty much going sideways with the 5 period, and we started to turn down with the 10 period. But if we see this really start to taper off and a whole lot more red coming in here, that's when we get more concerned. The advanced decline ratio is coming down, but we're still above 0. The accumulation distribution is rolling over, but we're still above the moving average. That's positive, and that's smart money. Looking at our trend, we're continuing to go up with the ADX, and we're above the moving average. The green line is coming down, but it's still on top, so we default to positive. The Arun is still positive. We're seeing that the green line, that's buyers, is on top. The red line has been coming down, so the oscillator is above 0 and advancing. The mass index, it's not generating a signal. Here's a daily chart. It's getting a little messed up here. I have another trend line that I'll show you here in a moment. And you can see the massive spike up in volume in Friday's session. This is the decision point scorecard, no changes. With their trend models, we're positive in the short, midterm, and long term. The PMO signals, we are negative in the short term, positive in the intermediate term, negative in the long term. And then this is the Keller market model, where we look at different indexes across the market. And we did see a switch where the Russell, these are the small caps, and the NASDAQ 100 have now switched to looking down where all of the other trends continue to be up. And here's the trend channel. We're still above the midpoint and for the most part, continuing to advance. That's still looking healthy. This is a chart I've just been harping on. This is probably one of the more important charts I've been watching lately. We came up to this R1 level. We came above it, then we broke down below it, then we were back above it, then we broke below it. Well, we were still able to close slightly above it, just about 6 points, but we're still above it for right now. Now, the reason why I talk about this is look at what happened back in 2021. We were humming along going up, and we hit one of these pivot points, and that's where we marked the top, and then 2022 happened after that. We finally hit a bottom. We started coming up. Then in the summer of 2023, we hit another one of these resistance lines and then spent the next few months going down. The market's in a real tug of war right at this level. If we can break above this, and the fact that we're seeing 2 lines above here, we're not seeing that in the past. We just kind of went up to that level, turned, and then started going in the other direction. We haven't done that yet. Now, it still could happen, but for right now, it's hanging in there. But when we look at the chart with the 50-week simple moving average, the red line is going up and price is above the red line. That's looking quite positive. Our chart with the moving average crossover is still positive. We're coming down and dropping below 0 with the McClellan oscillator, and we're seeing that on the daily chart as well. That's a little more negative. And we're getting back up to an extreme reading based on price with the summation index. We are continuing to go up based on volume. And the Swenlin trading oscillator is coming down, and we're still above 0 based on price. We're right at the 0 line based on volume, and we are starting to go negative now on the daily chart. The bullish percent index, we were able to get back above 70, and that's fine when we're still going up, but now we're starting to come back down. If we drop down below 70, that's more or less a sell signal, and the more we continue to fall, that's negative, and then we turn really negative when we drop below 50. Just so you know, the NASDAQ 100 bullish percent index has already dropped below 50, so it's showing more weakness. Looking at the PMO, these are our momentum oscillators. When we take the indicator itself, it's still going up, but we're getting up to this red line. We could still go above that, but sometimes this is when we start to get concerned. We're going up based on price and volume. So the momentum on the weekly charts is still looking positive, where the daily charts are pretty much flatlining. We did see a decrease in the PMOs that are rising. The buy signals are starting to go down, and we're just barely extreme when we look at the PMOs that are above 0, seeing kind of that same thing on the daily charts. We're not extreme with the percent B indicator. These are Bollinger Bands. The way that I look at them in this chart, we get a percent B reading when we close above or below the upper or lower Bollinger Band. And the fact that we're above the midpoint is positive, and we're not getting an extreme reading. Here's all of our different oscillators. Now, the top one, this is the slope, and this is more short term, it's starting to roll over. That's a bit of a concern. Our other short-term oscillator, the TSI, it's continuing to go up. Then in the intermediate term, we have the MACD, the PMO, and the PPO. These are still going up, and our longer-term oscillators, the TRIX and KST, they continue to go up. But on some of these, you can say we're getting to an extreme positive reading. The chicken money flow, it's weakening on the daily chart. It's still hanging in there here on the week. Okay, on the daily chart. It's hanging in here on the weekly chart, but it's still positive. But it has been falling back a bit on the daily chart. After being extreme, we're starting to come down with the chicken oscillator. The force index did decline, but it's still above zero. That's positive. We're still extreme positive with the money flow index. And this is just the rate of change from one week to the next. We had a slight down week this past week. Based on our 50-week rate of change, we are coming down after getting above this red line. Sometimes that's why I have the red line on here, because there are times when this can be an extreme positive reading. The RSI is still extreme positive, even though it is declining. And we're still negative with the weekly special K chart. We continue to be positive with the daily special K chart. The Stochh RSI is coming down, but is still extreme positive. The Williams percent R also declining, but still extreme positive. The ultimate oscillator just barely coming down. Then it started to go back up, but it's looking extreme positive. The vortex, we're seeing some weakness on the daily charts. It's getting ready to cross below the zero line there, but we're still looking okay here and working off a real extreme positive reading. And the Copic curve, it's starting to turn negative on the daily chart. Now it's starting to turn negative here on the weekly chart. We're hanging in there all right. Now we still have a lot of pivot, Fibonacci levels and moving averages that may act as support if we see some kind of weakness. And we're still continuing to decline with our 253 period simple moving average of the equity put call ratio. When this is going down, that tends to be positive. But when we look at a ratio of the VIX and then a 3-month average of the VIX, we're continuing to go up, and that's negative. Our different charts, we're still looking okay with the Heiken Ashi. We're going up now here. The Kegi chart is still positive. It's black and pointing up. The Renko chart is positive with the open blocks, and the 3-line break is still positive. We're seeing kind of a mixture on the daily charts where they're looking more positive here on the weekly charts. Here's the ease of movement where we're above zero. We're kind of flatlining and trying to turn back up. And then this is a signal that I just don't see very often. We see a lot of X's right here, and we're seeing a negative signal, a long tail up. This is suggesting that the point and figure is going, wait a minute, we're seeing an awful lot of X's here. Maybe this is getting out of hand. So this is kind of producing an extreme positive reading. And we haven't seen that change in the past week. When we look at our different longer term momentum, in the long term, we're continuing to go up. We're starting to show some weakness in the intermediate term, but we're still positive. We are seeing some weakness in the short term, but we're still above zero. And then we are going to have a new 50-day cycle that will start on Monday, March 18th. I had to adjust that. And then we're still remaining neutral with the Elder's Impulse system for the S&P on the weekly chart. We're still positive for right now in the parabolic SAR. I'm going to be watching the daily chart. If we see more of a decline, at some point, if we see a dot on top, that's going to turn on the daily time frame more negative. And then here's seasonality, where March tends to be a lot better than what we saw in January and February. And then looking at just a weekly chart of the S&P, where it's coming off of setting recent all-time highs. We did set an all-time high last week with the mid caps. The small caps are lagging behind. The Dow continues to be in an uptrend. The NASDAQ is also in an uptrend. The NASDAQ 100 in an uptrend. Here's a weekly chart where we are starting to roll over a little bit, but we're still looking positive for right now. The mid caps are still in an uptrend and just setting recent all-time highs, where the small caps, they're in an uptrend on the weekly chart, but they're just having a hard time breaking out of this range that we've been in. The NYSE is setting new all-time highs recently and in an uptrend. All stocks also coming off of just setting all-time highs and in an uptrend. The biggest software companies are in an uptrend, but still have a ways to go to set a new all-time high. The FANG index been seeing a little bit of weakness there, but we're still hanging in there. with the longer term uptrend. ARC is still in an uptrend, but it was actually down over 4% on the week. We're watching the banks just to see if there's more news that's going to come out. Or if we look at the RSI on top, we're just coming off of an extreme reading and the momentum is positive, but we're coming back down to the moving average here. We are still seeing more money going out of banks than are going into banks right now. And then we look at just a generic chart of Dow theory, where the Dow is coming off of recent all-time highs. The transports are just going sideways, and we're still seeing a real negative divergence. I'll be going over that more in the intermarket analysis video, where the utilities are under a lot of pressure now, and they're in a longer-term downtrend. Here's the broad market. The CRB is bouncing back up, but we're still in a longer-term downtrend. Oil is getting up to the 80 level now. Copper did see a bit of a shoot up. It kind of like that CPI, PPI thing. And so we ended up seeing some strength there. The dollar bounced up just a little bit this past week on the weekly chart. And the dollar going up typically puts pressure on stocks. Where gold is starting to break out, and you've got all the gold people just partying and just thinking, it's here, it's going to 50,000, or something. Silver did see an up week, but we're still in a downtrend on the weekly chart. Then looking at interest rates, we are still in an uptrend when we look at bonds based on price, but they've been chopping around and seeing a decline lately. When bonds go down, interest rates go up. But we still see on a monthly chart where stocks are outperforming bonds. We're still seeing this 1 month taking away the 3-month yield. It's still positive for right now. And this is a daily chart where we were coming down with yields. Then we started to go back up. Then we were falling down. Now interest rates are starting to go back up, and that's pressuring stocks. Here's a weekly chart with the US, UK rates being the highest. German rates were up, and we're seeing Japanese rates start to go back up. And then this is a chart that I've been showing for a while, just different times when we spiked as far as interest rates were concerned and then started to come down. This is when we hit 5% last October. And we're wondering, is something negative going to happen? Other times when something like this happened, it was a negative event, but we don't really know yet. The market's kind of taking it more as something positive. And then this is another chart that I did show, I think, for Monday's video. It's just a repeat. And this is taking inflation into account. That's what real rates are, that we came up here. And then when we saw the downgrade, that really produced a fall. Then we've been coming back up lately. Looking at some relative studies where we still see oil doing the best going back to the beginning of the year, followed by stocks, and then gold, and then the dollar, and the price of bonds are negative. The NASDAQ 100 to S&P 500 ratio, it did take a hit this past week, but it's still in an uptrend. The S&P 100 is still outperforming the S&P 500. Growth is still outperforming value. And gold is bouncing back up, but it's still in a longer-term downtrend when you compare it to the S&P. It is starting to break out above this trend line when we compare gold to the dollar here on the weekly chart. And this chart is also a weekly chart showing how bonds are underperforming stocks. Low volatility, really getting hammered here, really underperforming the S&P 500. Discretionary, it's pulling back. It's still in an uptrend, but it's not really going up with any real strength right now, even though it's outperforming staples. The energy sector still in a longer-term downtrend, but we saw energy really bounce up this week, so that's why we're seeing the bounce in this ratio when compared to tech. And then longer term, we have the NYSE breadth thrust that was triggered last October 2022, and we're still working off of that. That's longer-term positive. We're also working off recent ZWAG NYSE breadth thrusts that tend to be positive as well. These are longer-term positive setups. The Zohorchak is still full-on buy signal. That's also longer-term positive. And then with this trend line going back to 1987, the S&P is still above this trend line. Here's a shorter blow-up of that same chart showing that we're still quite a bit of ways away from this. If we start to fall with any real vengeance, we're going to be watching this trend line. And then we look at the NYSE new highs and new lows. This is continuing to go up, and that's positive for the broader market. We're also turning down just a little bit, but we've been really advancing when we look at S&P 500 highs minus the lows. And then here's a NASDAQ 100 weekly chart. We're coming down, but we're still above the longer term trend line going back to 2009. Then this is another chart I've really been watching because the perma bears are just salivating over this. They're just totally sure that we're going to hit these previous highs and turn and start to go down. And that could be very negative for the market. Now, it could play out that way, but we're not really seeing it played out, at least yet. And then this is a similar chart where we look at the QQQs to the small caps. We did come up and give a very high reading, and now it's starting to come down as well. And here's the cumulative new highs, new lows for the NASDAQ. It's continuing to go up. So that's longer term positive. And then the 3-month yield is pretty much going sideways here, but it's still above where we were back in 2007 before the great financial crisis. If some kind of major economic event happens where rates start really going down, that's what we're really watching for right now. But so far, we're just watching this chart. Seasonally, and these are charts that I just show now in the weekly video. This is put out by Dan Bird, where he does see some weakness going here into about the middle part of March, but then he sees some strength coming in as we head in closer to April. And then this is a chart that I've been showing for quite a while. We're comparing 1982 and then the rise up out of that with what we saw in 2023 and then the rise up. And this is what happened afterwards. And we're kind of going along the same basic scenario, at least for right now. And then I updated this because I had the wrong chart up a week ago. These are the statistics for March when just looking at the S&P from 1950 to 2023. We're up 48 times. We're down 26 times. We're up 64.9% of the time, and the average return is 1.1%. This is when we look at election years where we're up 11 out of 18 times, we're down 7 out of 18 times, and the return is 0.4% for March. So this is where I end it right now. I'm not going through the scenarios or anything like that for the daily videos. If you find that a real nuisance, if this is just ruining your day, please let me know if I need to add those things back in there. The idea is to take out the information that I've duplicated elsewhere and to maybe be able to talk a little bit more about things just when I'm looking at weekly charts. So have a really nice weekend, and I will talk to you in the next video.